Clearly, we're closer to euphoria now than we were at the beginning of what I still think will be called the roaring 2020s. And I think we're seeing that, though this time around, the euphoria is what I call FEMO, which is fabulous earnings momentum. It's not FOMO. The PE has actually hung around 20 for a while. Its earnings have been phenomenal. And then this morning we just heard that some of these AI companies are continuing to, have home runs.
Have home runs, absolutely. With CoreWeave last night.
Yeah.
I'm looking at the SPX. The normal weighted up 12-13%, but the equal weighted is up 15%.
That's right.
That's a good sign, right?
It's a very, very good sign. It's very healthy. And, I call the 493, there's a magnificent 7 and then there's the impressive 493. And so far this year, they're doing very well, which really shows that the market's broadening. And I think people have AI fatigue to a large extent. They don't really know which companies are going to be the winners or the losers. So they're kind of maybe buying indexes on technology. But the other companies in financials, industrials, healthcare, those sectors are at all-time record highs. And that's because people understand their businesses. And they also figure they might actually benefit from AI.
Yeah, I think everybody's trying to figure out the winners and losers. It doesn't appear that the Fed's going to help the market here. I guess it's a question of, will they potentially hurt the market by aggressively raising rates? And what's your call
I don't
there?
think it's going to be aggressive. I think the markets were sort of surprised when, during the first FOMC meeting that was chaired by the new Fed chair, and that is Kevin Warsh, where he came out so hawkish and said that his number one priority was to have price stability, because he admitted that the Fed has failed to get down to 2% for over 5 years. And then in July, he said it again, and the market said, well, you said that in June. Now, why don't you do something in July? And so I think the markets are expecting a September rate hike. And look, I think the bond market would react positively to it, which then would be a positive for the stock market.
Thank you so much for joining Bloomberg Money a couple weeks ago. We had a huge response to that. And the single Yardeni sentence, Paul, that stopped traffic on a Friday afternoon was rates are normal. Where rates are now is what they're supposed to be. Companies, this is an important concept. I want you to take it back to Yale Dynamics, linking economics into investment and finance. Companies can operate in a legitimate real interest rate, nominal interest rate environment.
Yeah.
A lot of the younger crew don't think so. They don't believe that.
Yeah. Well, something that does kind of get my my attention is these days is when people say, oh, interest rates are going to stay higher for longer, which implies that they should be lower. It's just we're going to be frustrated. But so what do you mean higher for longer? That 4 to 5% is normal. This is where they should be. This is where they were. The 10-year was before the great financial crisis. It was between 4 and 5%. Before the inflation crisis of the 70s, it was 4 to 5%. 4 to 5% is actually a vote of confidence. It shows that the economy can function very well. And by the way, it's kind of refreshing to see that the capital markets have been liberated from quantitative easing so that they can actually vote on where rates should actually be. And right now, I think 4 to 5% is a positive sign.
And we're seeing the new issuance in the investment grade bond market is off the charts.
And it's been absorbed very, very well.
Yep. How about U.S. versus non-U.S.? I'm looking at my WEI function, and there's good returns out there around the world, and maybe some better valuations outside the U.S. How do you think about that?
Yeah, well, we were pushing the idea of stay home, overweight the U.S. from 2010 until late last year. So we missed the rotation to go global. But we I think we caught up. We'll see, maybe I got whipsawed. But in December of last year, I said, you know what, I can't really recommend overweighting the U.S. when it accounts for 65% of the market cap of the global MSCI. So I said, let's talk about looking for opportunities overseas. And so far this year, it's kind of been even Steven. I mean, it hasn't been one or the other. Well, I mean, look, we got a global bull market in stocks. That's really what's going on.
I want you to address, as I did, I think it was Friday, the glass half empty crew. They need to participate. They need to retire. They need to be in the game, but their mental framework from childhood, whatever, just isn't Yardeni-like.
Yeah, well,
how do they participate?
They didn't have a happy childhood to a large extent. Look, I think they have to stop listening to the perma bears. The perma bears will get them out at the top, they'll get them out in the middle, and they'll get them out at the bottom. You'll never be in the market if you constantly get scared by the perma bears. With stocks, if it's not, if your day job's not trading, you've got to be long.
Dr. Yardeni says they're never be in the market. I would rephrase it broader, Paul, and say never participate in the American experiment.
Yeah, correct.
To me, it's a broader.
It's a broader, yes.
It's like almost a Robert Schiller kind of thing.
Exactly.
I agree with that.
If people are looking for opportunities outside of the AI trade, where do you kind of send them these days?
Well, I'm not that original. I mean, I just kind of look at all the sectors and see which ones are at new highs. So I kind of let the market guide me. And financials, industrials, healthcare are all at record highs. At the end of last year, we raised healthcare to a market overweight, and that's because we figured if any sector badly needs to manage information better, needs AI, it's got to be healthcare.
Tell me.
But financials are spending billions of dollars on fintech. You know, I'm really tired of getting checks from my clients. I mean, I love getting the money, but you know, why don't I just get Venmo for everybody by now? So I think there's a lot of productivity gains, and industrials, of course, are just benefiting from the ongoing AI boom, which I think is the real deal.
What's your concern out there? I know you've been bullish and you've been right.
Yeah.
What's the concern out there for you?
Well, you know,
I mean, geopolitics, it seems like the market's plowed through past that.
Well, you know, I think those of us who've been doing it for a while and those newbies who haven't and are getting instructed in history shows that geopolitical crises are buying opportunities. Yeah. The stock market actually bottomed a few months after Pearl Harbor when we blasted the Japanese Navy in Midway. And that was way before the war was over. And yet the market already, and look what happened this time around. The market bottomed on March 30th, and we haven't really looked back.